central banks are now figuring out, late to the party. And that's exactly what the de-dollarization thing with the BRICS is all about. We no longer want to save in U.S. Treasuries, U.S. dollars, or paper money. We need a real hard asset that holds its value, that is a store of value, that even the BIS has recognized as a tier one asset, the only other tier one asset besides the laughable 10-year. So these are not gold bug defenses. This is the flow of smart money late to the game. It's the flow of history at the end of a credit cycle. And it's the obvious choice. It's not even, as the ECB economists kind of hinted, gold isn't even an allocation. It's not even a speculation asset. It's not even a hedge. It is a part of the new system. It is a part of the new world reserve currency. It's because it's not the world reserve. It's not going to replace the dollar, but it is the new world reserve asset. It is a strategic reserve asset. It holds its value better than any sovereign bond, whether it's from Germany, China, Brazil, the BRICS, or including the United States.
Central banks are finally realizing, though late, that they can no longer rely on U.S. Treasuries or fiat currencies as safe stores of value. Emerging economies, including BRICS, are accelerating diversification, some even repatriating gold from London and New York for domestic storage and strategic alignment. Central banks worldwide are increasing their gold reserves and reducing their U.S. dollar holdings. A recent World Gold Council survey found that 95% of central banks plan to boost gold reserves within a year, while about 3/4 expect to reduce U.S. dollar holdings in the next 5 years. Gold is no longer just a hedge or speculative asset. It's becoming a core part of the new global monetary system. While it won't replace the dollar, it now stands as a more reliable store of value than sovereign bonds from any country, including the U.S. Matthew Piepenburg explains that he isn't a permanent pessimist. He was bullish on markets from 2020 to 2024, but is now bearish on risk assets for 2025 while remaining consistently bullish on gold for years. He recently wrote about gold being the perfect lie detector for financial markets. Despite being dismissed as too volatile, gold has outperformed the S&P 500 for the past 20 years and is the top performing asset in 2025. A recent ECB report acknowledged that physical gold demand poses a threat to the European system, highlighting the fragility of over-leveraged paper gold markets, derivatives, which don't hold sufficient real gold to meet their obligations. He argues that throughout history, from the U.S. decoupling from gold in 1971 to modern central banking missteps, monetary lies have repeatedly hurt economies. Gold, by contrast, remains honest and consistent. While politicians and central bankers manipulate fiat systems, gold quietly holds its value. Now, even the major financial players and central banks who once dismissed gold are stacking it in record amounts, validating the long-held belief in gold's role as an actual strategic store of value amid inflation, war. Here are key insights from Matthew's recent interview. Before diving in, don't forget to subscribe and hit the bell icon for timely updates.
Openly bullish on markets in 2020, 2024. I'm openly bearish on risk assets in 2025. So I'm not just a perma-bear, but I'm very consistent on gold's long-term direction, and I have been for years, certainly since I started working with a mentor like Ian van Greyers and understanding gold over the last many years. But what prompted me to write this article today, or that came out today, wrote recently, is gold the perfect lie detector, basically, for financial markets, is the reason gold is rising exponentially. Again, I don't know how many all-time highs we've had just in this year alone. It's the highest performing asset across the board in 2025. It's outperformed the S&P for 20 years on a total return basis. U.S. Treasuries are the worst performing asset over the last 5 years. They're down 50%. So this is not a gold bug, gold chill, sell your book, gold apology moment in history. And more importantly, gold has been very, very consistent for decades, frankly, for millennia, but throughout history. But as we hit this inflection point in 2025, there's so many strings we could pull on. But what prompted me to kind of just remind people of the dishonesty and how indestructibly honest, indestructible gold really is was some recent headlines, Elijah, that came out here in Europe, and they were on all the mainstream and yellow journalism. It was just everywhere in Switzerland and Germany and France, etc., that the ECB was making headlines because a group of economists at the ECB finally said the quiet part out loud, as I like to say. They couldn't, it's like a Freudian slip. They said gold could bring down the European system. Now, that's an extremely extravagant phrase. It made headlines, gold bringing down the EU, gold bringing down the economy. It wasn't that gold was doing anything than what it always does, which is hold its value, while paper money gets increasingly debased to monetize frankly, criminally negligent monetary systems in the EU and the central bank at the ECB. And basically what this ECB economist report was is all the physical demand for gold is undermining the European system because there's been such a massive outflow, as you and I have been talking about over the years. Certainly with COMEX, and Andy Schekman's been following this, and I've been following this, and you understand that these flows from the London to the New York exchanges, way beyond just BRICS and de-dollarization, but this need for physical gold and not future contracts on the COMEX or the LBMA exchange. So in other words, countries want gold, but they're in all these derivative levered products levered 100 to 1. And long story short, Europe doesn't have the gold or the money to meet its contracts, and they have over $1 trillion in derivative exposure to gold. Hence the headlines, could gold bring down the European system? It's extravagant, but what I'm basically saying is the European system, the central banks, the LBMA banks, the derivatives markets, all these weapons of mass destruction are finally being admitted to and confessed by even the economists at the ECB. And so basically what they're admitting to is it's a lie that paper contracts levered 100 to 1 do not equal an ounce of gold. In other words, they don't have the gold or the money, and they're caught in a major pickle because the counterparty to these European contracts is effectively Wall Street. And again, as things get more and more desperate, again, any string we pull, military issues, geopolitical issues, debt issues, bond issues, risk assets, stock issues, private equity, as things get more crazy, gold becomes more relevant as a conversation piece, as a store of value, and as a sane truth teller. And the truth is, once again, there was another open lie that derivatives and futures contracts and paper gold is not gold. And now there's $1 trillion uh-oh moment in Europe. And when that headline came out in the last week or so, it made me think, Elijah, of the broader theme of dishonesty, for which gold always kind of quietly bides its time and does its honest work. And I was thinking, in the course of my entire lifetime, which I was born in 1970, so we went off the gold standard in 1971. Nixon promised A, that was just a temporary measure, and B, that your dollar would be worth just as much tomorrow as it is today. So that was the first open lie. Obviously, decoupling from gold has not been temporary. The entirety of my life, we're still decoupled from gold. We don't have a chaperone to our fiat money. And the US dollar has lost 99% of its purchasing power and measured against a milligram of gold. So that was the first obvious lie. Let's just call a duck a duck. And as I was saying that, it's worth noting that even the U.S. Constitution, Article 1, Section 8, our founding fathers said, don't go into the trap of separating your currency from gold and silver, because if you do so, you'll be seduced by that siren of debt. You'll print more money, you'll create more money than you have gold, and you'll go into hyperinflation. That will slowly create social unrest and destroy your country. That was warned 250 years ago by our founding fathers. We violated that in 1913 when Wilson lied again and created the Federal Reserve Act, put the Federal Reserve into law. Then I was just thinking of more modern examples. When I was once and became a professional on Wall Street, I remember certainly the great financial crisis of 2008, which is effectively a credit crisis from derivatives, unregulated derivatives and mortgage-backed securities levered to the moon. And when I was at Harvard, Larry Summers was the president, and then he became secretary of assistant secretary of Treasury. There was a famous thing that never made the headlines. When he was at the Treasury Department, he called up Brooks Lee Bourne, who was the head of the CFTC, which was the commodity office, and he wanted to just lever the heck out of derivatives. And she was saying, this is a very dangerous thing. I don't think you should do that. He publicly humiliated her in Congress and said, trust me, the bankers and the counterparties in these derivative markets know what they're doing and can manage the risk. Well, within 7 or 8 years of him saying that, we had the biggest derivatives explosion, the greatest financial crisis in years, and that was the great financial crisis of 2008. So the Harvard president, the Treasury official, and the great mind of Larry Summers was completely dishonest and wrong. And that was just a recent example. And more recently, of course, we knew in 2021 when we had this inflation spike due to the money printing that Bernanke unleashed and got a Nobel Prize for. Powell said that was transitory. Again, that is not the case. We can bring the CPI down by lying about it, but we still have a major inflationary problem and a major inflationary discussion to have. So we didn't beat inflation. We still, even at the dishonest numbers we're at now, have not reached target inflation. So that was just another kind of a lie. And then again, The lists are long and distinguished. You can get outside of the markets. You can get into politics. We have these phrases like the Patriot Act or the Department of Homeland Security, or more recently, safe and effective or trust the science, these buzzwords. But in the case of gold itself, again, gold sits back during this whole string side of dishonesty. I talked to investors from Dallas to Davos. It's amazing what the registered advisory industrial complex or the wealth managers at the big banks, whether it's Pictet or Goldman Sachs or Morgan Stanley or JP Morgan or Bank of America, where you have to have high minimums just to get their advice. They all said, recently, until gold made the headlines, is, well, I was always told that gold was too volatile all these years. And yet, again, that's just a lie. Either it's really ignorant or really dishonest. And again, I'm not making these numbers up. Gold for the last 20 years has beaten the S&P on a total return, including dividends. So for 20 years, it's outperformed the S&P. It's certainly outperforming the sacred cow U.S. 10-year Treasury, the risk-free return, the haven. It's outperformed that dramatically. And again, it's the highest performing asset this year, which is why it's getting attention. But it shouldn't be because it's outperforming just this year. It's been outperforming for years. And yet we've had to apologize as gold bugs for being gloom and doom. And so the lie that's been told to many investors, too, is that gold is too volatile. And yet now central banks around the world, including the ECB, are trying to get as much as they can. And my whole point was, when the liars have to tell the truth, and when the liars are actually stacking gold at record levels, that's when you know there really is an uh-oh moment. And certainly we understand gold. This is nothing new to us. We're not, even as Jeffrey Gundlach had confessed, these gold guys aren't maniacs. They're not stackers. They're right. He just said it. So again, it's not about being a gold bug defendant or apologist or shill. You look at Ray Dalio, the biggest hedge fund manager, Bridgewater. These guys are all talking about gold now with conviction. We've been talking about it for decades with conviction. So again, it's not a gold bug apology to tell the truth. And what I guess I meant by that article is, gold has been telling the truth for a long, long time. It's been bailing out broken systems for decades, centuries, and millennia, from ancient Rome to the 90s in Yugoslavia, again to 1879 France, certainly the extreme examples of Weimar Germany. But governments always get over their skis in debt, and they always destroy their currency to monetize that debt. But it always ends in the permanent ruin of war and inflation. And what are the major concerns right now? The honest concerns about on anyone's mind is inflation and war. And there was a tweet that came out the other day: the debt keeps rising, the bombs keep falling. So it's not a coincidence that we're in this moment in history. Gold is reaching all-time highs again. Policies.
Gold is gaining significant attention, with even ETF inflows rising as its price climbs. Yet experts stress that physical gold, not paper gold, offers real protection. This momentum isn't just about chasing returns. It's a sign that more people are waking up to gold's role as real money, not a speculative asset. In a fragile economic backdrop marked by recession risks, inflation, and mounting debt, physical gold is being viewed increasingly as a strategic necessity rather than a luxury. Central banks, institutions, and individuals alike are turning to gold not just for appreciation, but to preserve purchasing power as fiat currencies decline. Matthew Piepenburg highlights that, despite mainstream resistance and late institutional adoption, gold's steady rise is a response to the structural failings of the global financial system, the end of the credit cycle, overexposure to illiquid private credit, and the erosion of trust in fiat-backed assets have all pushed gold to the center of a new monetary reality. It's no longer just a hedge or speculative bet. It's becoming a foundational reserve asset for a changing world. The narrative has shifted from gold versus stocks or crypto to gold as a necessary pillar in a system under deep strain. Now let's dive into the interview.
I'm encouraged to see even ETF inflows into gold now as it's making headlines. I hope people understand that ETF gold is not the same as physical gold. We've talked about that and written about that, but at least it's a sign that there's a move into gold. Many of that demand may come from people just chasing price, like whether it's gold or Nvidia or Bitcoin, they're agnostic. They're just seeing it up 25, 26%. Let's get in. And they're always coming in late on just the price momentum. As we've always said, gold is not a momentum trade. It is a new form of money. It is real money, and it is a long-term investment, and it is there to ensure against the dying purchasing power of your fiat dollar. Nevertheless, it is encouraging to see flows into gold ETFs, but we've always said physical gold is the only way to go. It is interesting that the common man, if he can, and I respect how difficult it is to get an ounce of gold if you're worried about rent mortgages, car payments, insurance, etc., in a very recessionary backdrop, which is only going to get worse rather than better. Of course, it's hard. But as Egon and I've tried to say, get as much as you can, as realistically as you can, bit by bit, time by time. We've been saying this for years. Now with the price, as you said, near 3,500, there's a race to really do that. You look at Harvard, again, I mentioned that because of Larry Summers. Harvard's endowment's over 50 billion, but they've had to issue bonds recently because they don't have liquidity, because most of their money is tied up into these credit pools, private credit pools, which are, again, Gundlach, who's the bond king, says those are the weapons of mass destruction. I just wrote an article about private equity, which is the belle of the ball, the prettiest girl to dance for many institutions and family offices. Private equity is turning as well because they're not marked to market. They're whatever the accountant at the private equity or private credit fund says they are. When there's volatility in the markets, those valuations tank, and the liquidity is not there as we head into the end of a credit cycle. So again, the smartest guys in the room too, we're chasing the trends, chasing the CIOs of those family offices or those endowment funds, which are just alumni from former banks who are just thinking the way they've been trained and thinking, frankly, in I would call a sustained level of mediocrity. Honestly, it's consensus think, it's safe. It keeps you hired at Harvard or at Goldman to be bullish and to sell diversification models that always work in a bull market when things are going well. And when things start to fall apart, then they come racing in trying to figure out a non-dollar asset, hard assets, including gold, including silver. But even the smartest guys in them are late to the party. And, family office is running around to unload their private credit investments at a discount because they misallocated. Because they misunderstood wealth management, risk management in the form of that pet rock analog old gold asset that no one wants to talk about, but has been quietly telling the truth for centuries and frankly for decades, just in recent memory. I find that staggering. And I find it really funny and comical when people say you're just selling your book when gold has just been quietly outperforming everything else. It's not to say I told you so. It's not to be smug. It's just to tell the truth as we see it and as the facts show them and as the numbers tell us, and to get more people not to just become a Von Greyer's clients. It's to get people to understand the risks they're facing. That gold for us, and certainly for Egon Von Greyer's, who did buy gold and lots of it at $300 many years ago, who has made a very modest fortune, who never brags about it, but has never wavered on the price of gold or the direction of gold, never once apologized for gold. He has high conviction, but he never bought gold just for the price appreciation. Of course, he's happy to see it go from 300 to 3,400, but that was never his goal. His goal was, I need to protect my Swiss franc, my euro, my dollar from itself. I'm going to save in gold and spend in fiat. That's exactly what our clients do. That's exactly what the central banks are now figuring out, late to the party. And that's exactly what the de-dollarization thing with the BRICS is all about. We no longer want to save in U.S. Treasuries, U.S. dollars, or paper money. We need a real hard asset that holds its value, that is a store of value, that even the BIS has recognized as a tier one asset, the only other tier one asset besides the laughable 10-year. So these are not gold bug defenses. This is the flow of smart money late to the game. It's the flow of history at the end of a credit cycle. And it's the obvious choice. It's not even, as the ECB economists kind of hinted, gold isn't even an allocation. It's not even a speculation asset. It's not even a hedge. It is a part of the new system. It is a part of the new world reserve currency. It's because it's not the world reserve. It's not going to replace the dollar, but it is the new world reserve asset. It is a strategic reserve asset. It holds its value better than any sovereign bond, whether it's from Germany, China, Brazil, the BRICS, or including the United States. Get past politics, get past partisan thinking, get past bull or bear on the S&P, get past strong dollar, weak dollar, milkshake or no milkshake, get past Bitcoin versus gold, because it is the evident truth all around us, whether you're looking at bonds, currencies, central banks, the BIS or the IMF, they all, or the BRICS or the oil trade, everything is about gold at the center of the narrative and about inflation being inevitable, even if we have deflationary periods. It's just trying to shake you by the shoulders and have you look at this. Doesn't mean become a devotee of Von Greyer's gold or Matthew Piepenburg or Grant Williams or Ronnie Sturfula or anyone else or Andy Scheck or anyone else who understands sound money, or yourself. Do your own homework. Look at the facts. You can have different opinions. Even Gundlach, who says, look, if you guys are into Bitcoin, and you like the leverage, you like the return, just buy gold and lever it then if you want. If you want, it's going to be more stable. So again, it's not even about these debates anymore. They're getting tiresome. They're important. We could keep having them. And I'm not even saying that gold goes in a straight line. It's just obviously rising because paper money is falling. And paper money is falling because, as history confirms, the debt is too astronomical in these trillions, these unfathomable numbers. And anyway, another long-winded answer, but I just can't understate it or overstate it, enough. That gold is far more than a hedge or an asset class to speculate in. It is literally becoming a new center to the system that's crumbling all around us in any string you pull on, whether we're looking at geopolitics, bond markets, stock markets, tariff wars. Everything comes back to the fact that these countries are broke and desperate, and they're looking for some way to fix things, which is a little too late, I think.
Gold is reclaiming its historical role as the ultimate store of value amid growing economic instability and disillusionment with fiat systems. As global debt mounts and central banks scramble for reliable assets, gold stands out not for hype, but for its enduring truth. Its rising demand, especially physical gold, signals a shift in mindset, from speculative greed to strategic preservation. In a world of financial illusions, gold is proving to be the one asset that doesn't lie. With central banks increasingly turning to gold, how might this shift reshape global financial power structures in the next decade? Could rising physical gold demand eventually expose and destabilize the paper gold derivatives market? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up, and remember to subscribe to stay updated. Thank you for being a part of this journey with us.